Today on Toni Talks, I'll be joined by CPA Jeff Stulken and attorney Amanda Wynalda. We will be discussing cost segregation. So we'll get into what cost segregation is, the maximum benefits of cost segregation, and how to use it. So let's just get into it. All right, so today I wanted to talk about a very popular topic that was, I'd say, made more popular by the 2018 Tax Cuts and Jobs Act, which is cost segregation. And Jeff was just talking about the piece of it before we hopped on that made it so popular, and that is the bonus depreciation. Saying a lot of hot button words right now. But before we hop into those things, let's go ahead and talk about what cost segregation actually is. What is cost segregation?
Okay. Cost segregation is nothing more than you're taking your rental property or any property, and normally it's 27.5-year depreciation. So a cost segregation will take a look at that property and will reallocate the non-structure items of that property into shorter term life, 15-year life, 5-year life, and then you're going to take those costs and move them down into a shorter life and makes them eligible for 100% bonus depreciation in the current year. So you've just taken something that has been 27.5 years, moved it to shorter life, and you're able to expense the entire 100% in that current tax year.
Sounds like a juicy piece of steak to me. So yeah, cost segregation is at its core, it's accelerating your depreciation without necessarily for tax purposes being treated as acceleration, because, and I make that point because when we're talking about depreciation recap, accelerated depreciation is taxed as ordinary income instead of capital gains. So when I say accelerated depreciation, to the point Jeff was making, instead of it being 27.5-year property, I can benefit from cost segregation by simply taking out the personal property component. So any non-structural component and making it personal property, which can be deductible or depreciable, I should say, over shorter life. So 5-year, 7-year, 15-year.
Mm-hmm. And these are things like 5- and 7-year property would be things like carpets, countertops, cabinetry, wall coverings, removable flooring, machinery, blinds, windows, window coverings, land improvements. Things that are 15-year property are things like parking lots, curbs, gutters, sidewalks, irrigation systems, storm drains, trees, shrubs, landscaping. Like the cost segregation company that we refer clients to actually goes out there and counts the trees when they're doing that study for you. Everything else that's the 27.5 or 39-year property for commercial properties are like the steel structure, the roof, the walls, the doors, the windows, the HVAC systems. So it's separating out each little piece and applying that useful life to that individual piece.
Absolutely. And you do want to make sure that you're taking into consideration the difference between federal and state. Not all states adhere to it, right? So they don't observe the accelerated depreciation, or I should say the bonus depreciation. But no state can tell you that your property isn't 5 or 7 or 15-year property. If you do a cost segregation study and you're able to reclassify some of the assets of the property, you're still going to be able, regardless of whether your state observes bonus depreciation, you're still going to be able to accelerate as it relates to shortening the lifespan and being able to take the depreciation over the shorter period of time. But you may not be able to take 100% bonus depreciation at the state level. So that is something that you are going to need to consider with your tax planner at the time when you're going through and looking at these things. But let's take a quick step back, right? So all of that is fantastic. We now know that cost segregation is a way that we can reclassify some of our components of our property to make it shorter useful life and possibly accelerate that depreciation, meaning take it 100% in the current tax year. But what does that mean for me overall? Sounds great. What does that mean for me? So number one, obviously, we're talking about rental real estate here because we're talking about doing, when we're doing a cost segregation, we're talking about depreciation. So we're talking about a capital asset. So we're talking about rental real estate. That means I'm going to have a higher deduction to take against my rental income, which could be significant depending on the cost or the cost of living in the area and the fair market value you're allowed to charge, you're able to charge for rents. But clearly a cost segregation can accelerate my depreciation expense to a place where I have much exceeded my rental income and now I have a loss. So now what?
Now it really depends on your personal situation, because we've talked about this in a lot of other videos, but passive activity loss, or PALs, are not really your PALs unless you have a fairly low income or unless you qualify for real estate professional status, because those passive losses will do nothing to offset active income, such as income coming through a W-2, unless you meet certain requirements. One of those is if you can deduct up to $25,000 if you make $100,000 or less in income. As your income goes up to $150,000, that $25,000 benefit slowly decreases to the point where if you earn $150,000, you have no benefit from that at all. The alternative is if you qualify as a real estate professional.
And another benefit of cost segregation that I think people don't typically think about or look at is that there is a benefit when you actually go to sell the property, because, right, since we're accelerating some of this depreciation, is coming off of that 27.5-year useful life. So we can have a disposition of some of the cost basis that's no longer useful, right? So if I had carpet, old grimy carpet in the house, and I didn't do a cost segregation, it would just still be in my cost basis for the property when I sold the property. But I'm not going to get that. And to kind of fill you guys in on the point that I'm making here, I'm talking about depreciation recapture, that you're not going to have to recapture the depreciation on assets that are no longer useful because you've cost segged it, you accelerated, the useful life is over for that. So we can actually take that off the asset schedule now, and we don't have to recap that when we go and sell the property. So that is another benefit of doing the cost segregation study and taking that on your return. Now, can I take advantage of a cost segregation study on a prior year return? The answer to that is
Yes.
maybe.
Yeah, that's what I was going to say, maybe, and I didn't know if I wanted to. You go ahead there. Yes.
The answer to that is maybe. It has to be done on a timely filed return. So we have to do what's called a change in accounting method. And usually when we're doing planning with our clients here at Anderson, if we know that we want to do a cost segregation study, we'll go ahead and do that change of accounting method right now in the current tax year, so that if you do the cost segregation study, say next year, I can actually amend my tax return for the prior year to do the cost segregation study. The important piece is that you did the change in accounting method. If you have not done a change in accounting method for that tax year, for that prior tax year, you're not going to be able to go back to a prior tax year and amend to do a cost segregation study. You're also not going to be able to do a cost segregation study on a late tax return.
Right.
Okay.
That's Form
You can do it
3115, and that's change of accounting method. Yeah, and yep,
But you can do it on an extended return.
Yes, you can
Yes.
absolutely do a cost segregation study on an extended return.
So that means that cost segregation as a tax strategy is one of those few strategies that you can actually implement after the tax year is over. So if you just, even if you don't have the study done in the tax year in which you want to apply it, you just have to have it done before you file that tax return. And that, of course, that's either timely filed or timely filed with the extension. So if you're in March, let's say, you can get the study done, apply it to the prior year when you file that tax return in April.
Absolutely. And another thing that we can talk about as it relates to cost segregation studies is having it done by a professional versus perhaps using a software. There are softwares out there that run you maybe, is it as low as like $600 or something like that, that you can use to do a cost segregation study versus doing a study with a professional or engineer or company that does it, that can run you maybe a few $1,000s. And the difference is going to be whether you actually have someone who's going out to the property and, like Amanda was stating earlier, counting every tree and shrub and really looking into everything. So one of the companies that we refer to, they actually will do a cost benefit analysis for you at no cost. So I think that's worth it to you. And it also depends on the size of the property, if you will, or in terms of amounts, right? So there, I might use the software if, and cost is a relative issue, isn't it? I might use the software if I'm talking about a property that's 100, 200,000. But I want someone in the weeds if I'm talking about a property that's 500 or better. Wouldn't you guys agree?
agreed.
Definitely, definitely. And you have to look at what you're saving. I mean, if you pay for a study, and even if it costs $10,000, that seems like, oh my gosh, that is a huge amount to be paying for this study. But if you're saving 20, 30, 40,000 in tax, it's well worth it.
Absolutely.
Yeah, and we've seen numbers more than that too, of course. And again, this is the legal and professional expense that is completely deductible on your tax return, so it isn't a completely washed cost. Yeah.
Absolutely. And another thing that we cannot get away from talking about, we're talking about cost segregation. We touched on it, I should say, a little bit, I think Jeff did, and that's real estate professional status. So one thing to understand about real estate professional status, I've been watching our previously filmed Toni Talks that gets a little bit more into it as it relates to real estate deductions, but is that if I qualify as a real estate professional, say in 2021, but I did a cost segregation study in 2020 when I was not a real estate professional, that cost segregation study resulted in a passive loss that carried forward to 2021. I'm a real estate professional now in 2021. That does not release my passive losses. So it's important that when you're planning this, you make sure you do your real estate professional status, make that requirement, and then take advantage of the cost segregation study after you've qualified as a real estate professional. I can do my cost segregation study, have my cost segregation study done in 2020, and then report it on my 2021 tax return when I qualify as a real estate professional. Now, as a real estate professional, I've aggregated all of my real estate activities, which means that I'm not going to be able to deduct any losses, or excuse me, I'm not going to be able to deduct any suspended losses that I may have had prior to qualifying as a real estate professional until I dispose of substantially all of the activity. And I say that just to really drive home the point that you want to make sure, if we're doing a cost segregation study, that if we're doing it if we're doing it for the purposes of reducing significant rental income, that's fine. But if we're doing it to be able to take that loss against ordinary income, we need to qualify as a real estate professional first, okay? And I'll make a very quick point about syndication deals. So if you're doing this through a syndication, there is going to be a difference, or excuse me, if you're running rental real estate through a syndication, there's going to be a difference between whether you're a limited partner in a limited partnership syndication or a member in an LLC syndication. So the limited partner is passive in nature, and there's a very narrow set of circumstances under which you'd be able to aggregate that limited partnership interest in to your real estate professional status. Whereas as an LLC member, it's going to be a little bit easier to qualify for that. Because remember, real estate professional status has that material participation requirement. And you're not going to be able to meet the material participation requirement in most syndications if you're simply a limited partner or a member of a limited partnership or an LLC as a syndication versus being a general partner or a managing member. So that's one thing to keep in mind. Typically, I'm going to say typically, your investment in a syndication deal isn't going to be able to be looped into the grouping for your rental real estate professional. And that costs, because we know a lot of real estate, or excuse me, a lot of syndications like to do those cost segregation studies that pass through a loss to you. But keep in mind, even though it doesn't get grouped in, syndication deals usually aren't super long-term, right? So once that syndication deal is disposed of, you will be able to go ahead and take advantage of those suspended losses as it relates to that. Well, I hope you guys found this to be informational and helpful to you today. Thanks so much for joining us. And if you'd like to discuss any of these topics any further with any one of us on this call, you can go ahead and give us a phone call and we'll get something set up. Thank you.